I think it depends where you look. I think that generally in these types of big kind of turning points in say high debt, high inflation situations, there are some countries that can try to turn to austerity, but in many ways, that's what they've been doing for the past 10, 20 years. I mean, if you look at infrastructure spending in the United States, for example, it's gone way down until some of these recent bills that put money for the longer term. Europe's kind of known for not very doing much infrastructure spending. And I think that some of these countries, it's kind of like once you get past the event horizon where they kind of see that that austerity is not going to work, they almost go in the other direction. They're like, well, let's do $1 trillion in infrastructure. So I think this is going to be an environment where it's very country specific. I think we're still going to see more infrastructure spending in a number of developing countries, and I also think that we're going to see at least targeted infrastructure spending in some of these more developed countries, especially around energy. I mean, if you have just reoccurring problems, I think you're going to see more and more of that. And then one of the risks is that the governments could interfere with say private spending, right? So for example, right now there's an energy shortage. Oil companies had a very rough, call it 10 years. A lot of them went bankrupt back in 2015, 2016 after the oil price crash. Some of them went bankrupt again, or ones that didn't go bankrupt, went bankrupt in 2020 when oil went, negative for a period of time, and then it was super low all year. So no one rushed in to help them then. But now that they're actually having pretty good margins, there's calls for windfall taxes and nationalization and things like that. So if you're like a oil executive and you're kind of looking at some of these longer term projects like offshore drilling or a big pipeline project, you now have to factor in not just the risk of the underlying, what's going to happen with the oil price, what's going to happen with this, what's going to happen with the cost of capital. You're also now saying, okay, well, what happens if half my profits are capped? Right, so I have all the downside risk, but potentially some of the upside risk is taken away, and so that can actually delay or prevent some of those supply additions. So I think it's going to be very country specific. I think some countries are going to go in some directions where it ends up limiting the type of kind of real world investment that can happen, whereas I think other countries are going to kind of push it hard, and they're going to do what they call, and we already see some of this, spending to reduce inflation. Right, that's how it's going to be phrased, which is they're going to insist on the idea that it's a long-term investment, and that has some degree of merit if you're sure that the money being spent is going to be spent productively, right? If you're actually going to reduce some supply issues, then ironically spending money can reduce inflation. I think the big challenge is actually doing it in such a way that it does what it says it's going to do and on a reasonable time frame. So I think there's a good chance it's bottomed. It's showing a number of signs that have been consistent with prior bottoms, right? So for example, the market price is below the realized price, and the realized price is like the on-chain cost basis on average. Obviously, everybody has their own cost basis, but if you aggregate all the times like the coins last moved, with some adjustments for known entities and things like that, there's companies like Glassnode that specialize in that type of analysis, and that market price is below the realized price, meaning the average on-chain Bitcoiner is slightly in the red, and normally that is a bottoming type of process. Now there are still shocks I can imagine that give us another leg lower, right? So if the Fed stays super hawkish, if you get just the dollar just completely spikes, dollar index soars to over 120, I can imagine a lower low. It's certainly not out of the question. People should not invest in such a way that they are sure that the bottom is in. But I think we are starting to see higher and higher probability that the bottom is a good chance of being in. And the way I would phrase it is that while we still have a tight Fed, this goes back to my prior point about not trying to kind of call a pivot ahead of time and being defensive until you actually see tangible reversals. I think as long as you're in a declining PMI environment, strong dollar, Fed tightening, you have to be a little bit defensive here, even on Bitcoin. And kind of just humble about it's very hard to predict what's going to happen in a 6-month period with it, but I think that it's already at a point where it's in what I would call a deep value zone, and so I think it's got a very high probability of having say very good 3-year returns, even though I think the next 6 months are still quite questionable. So I think it's a good period for accumulation, dollar cost averaging, unlevered ownership, but I would be careful with anyone wanting to. So in the United States, we unfortunately don't have a a normal Bitcoin ETF yet, right? You have a futures one. Canada has a good ETF, and that platform has some. That platform I use for that portfolio has some limitations on what securities you can pick, and so I generally would recommend directly owning Bitcoin where possible. To personally own it. If that can't be done, I mean, if you're in a country where you have a spot ETF, I think that's a good product for like a brokerage exposure, right? So you have price exposure even if you don't have underlying exposure. And then as you go from there, you have other options. One is the miners. I used to have a little bit of mining exposure, but I took that away a while ago, and I'm glad I did because we've seen a lot of turmoil in the mining sector. And so I've been focusing on GBTC as one of the ways to hold it. Now, it's both good and bad because you're buying Bitcoin at a discount. It's over 30% discounted to NAV. The downside is there's no real catalyst for why that should go away anytime soon, other than being allowed to one day convert to an ETF. So it's kind of like you're buying discounted Bitcoin with an extra call option on should that ever become an ETF. You close that gap when that happens. On the other side of that, if years go by, it's not allowed to convert to an ETF. There's no end in sight for its existence as that fund. There's nothing really preventing it from going to a -40 or -50% discount to NAV, and so it doesn't provide that clean Bitcoin price exposure in a way that either a spot ETF would, or preferably directly owned Bitcoin would. So I definitely think that people should directly buy Bitcoin and self-custody it. But if they are, for whatever reason, in a kind of walled garden environment where they want Bitcoin exposure, but they have limited options, I think Grayscale is one of the options. I'd just be more cautious with position sizing with that than I would be with Bitcoin itself. A lot of things that I was following a couple years ago that it would be considered missed, like what was happening in energy, for example, are now being covered quite heavily. But I think what's still being missed is some of the underlying reasons or duration of some of these things, right? So when people look at energy markets, they often think of Putin's war, for example. And while that was a variable, an underlying issue is a lack of capex and a lack of kind of marginal new supply that can come onto the market. We don't really have, the whole last decade we had U.S. shale just constantly ramping up and bringing new supply to the global market. And that's not really happening anymore. We've kind of already got the low-hanging fruit from that new technology in that region. And so I think going forward, we have ongoing questions about where are we going to get abundant, cheap energy. And, I think we're in an environment where we've seen the inflation spike, and then in many countries, we're starting to see disinflation, right? With central bank tightening, with strong dollar, we're starting to see some of that disinflationary pressures, and I think a lot of people assume that once that goes down, it's just behind us now, and that was the story that happened. Whereas I think an issue is that inflation is ready to return. Should, for example, the Fed eventually pivot or get dovish in some way. Basically, as long as they stop holding down demand, like as long as the supply side's unaddressed, it's ready to come right back. And I think that some of the inflation we saw was say COVID specific. People rapidly changed their demand profile, right? Because if you were locked at home, you stopped buying certain services, you bought more products, goods, and then as things opened up, you kind of went back to a more normal consumption pattern. And so some of that was temporary disruptions. But I think the longer term underlying inflationary variable to watch is basically oil and gas and nuclear capex, basically baseload energy capex. And I think that's still going to be a longer term inflationary pressure. And I don't think the media's or financial media or investors in general are kind of fully appreciating some of the risks and pressures there.